everyone, welcome back to the channel. Netflix just announced a 10 for 1 stock split that's set to happen on November 10th, 2025. That means for every single share of Netflix you own, currently trading around $1,100 per share, you'll soon own 10 shares worth about $110 each. Now, in this video, we are going to talk about 5 stocks that could become great buys if they ever announce stock splits or even before that happens. I'll also share some examples from my own experience where I made money from stock splits and a few that didn't quite work out the same way. But before we get into those 5 names, let's start with what this Netflix split really means and why the company is doing it in the first place. Before we dive in, if you could just take a second to like the video and subscribe the channel, it really helps grow the channel and I genuinely appreciate the support. Thanks for doing it. Now let's jump right in. Stock splits always generate a lot of buzz among investors, but remember, at the end of the day, it's a company's fundamentals that truly move the stock over time. To understand what's really happening here, think about this simple analogy. It doesn't matter whether you have one $10 bill or 10 $1 bills. The total amount of money you hold is still the same. Similarly, after the stock split, Netflix shareholders will simply own a greater number of lower priced shares and the total value of your investments doesn't change immediately. However, this is where investor psychology kicks in. Over the past several years, we have seen how the excitement surrounding a stock split can actually push the stock higher, and even when the company's fundamentals haven't changed overnight. Experts often point out that by lowering the share price, the stock becomes more accessible to everyday retail investors and even company employees. In fact, Netflix clearly stated in its press release that the decision was made to reset the market price of the company's common stock to a range that will be more accessible to employees who participate in the company's stock option program. So, while the split itself doesn't magically create value, it does make Netflix stock feel more approachable for a broader range of investors, which can sometimes create short term demand. Even though the stock split itself doesn't make Netflix a buy, the underlying fundamentals tells a different story. So for the first 9 months of 2025, Netflix revenue grew 15% year over year, hitting $33.1 billion dollars. Meanwhile, earnings per share jumped 26% to 20.12. What's even more impressive is the operating margin. It expanded to 31.3% this year, up from 27.4% in 2024 and 20.9% in 2023. That means Netflix isn't just growing revenue, it's becoming more profitable as it scales, even with continued heavy investment in content. And they are not slowing down anytime soon. Netflix has a packed lineup heading into the fourth quarter, including the highly anticipated final season of Stranger Things, new seasons of The Witcher, Emily in Paris, Love is Blind, and Nobody Wants This. They're also bringing sports into the mix with NFL Christmas game day doubleheader featuring the Cowboys versus Commanders and Lions versus Vikings. In short, Netflix has a deep content pipeline that keeps engagement high, which directly fuels subscriber growth and revenue. And looking at their valuation, the stock isn't cheap. It's currently trading at around 34 times next year's earnings expected. But given the company's consistent execution and its projected 12% annual revenue growth over the next 5 years, that valuation seems reasonable for a high quality growth business like Netflix. And by the way, if you missed my full deep dive video on Netflix business model, where I broke down the bull, base, and bear case scenarios using a detailed analysis, I'll link it in the description below. So definitely check that out after this one. So, to be clear, investors shouldn't buy Netflix just because of the stock split. The real story is about a company with a proven record of performance, strong cash flows, and exceptional execution. And that brings us to the interesting part, which other companies could potentially see increased investor interest if they were to announce a stock split. And just to be clear, this is not a financial advice. I'm not making any investment recommendations here. I'm just sharing my thoughts and analysis, and none of the price targets or projections mentioned are guarantees. They're based on my own valuation models and market assumptions for educational purposes only. So please always do your due diligence before making any investment decisions. All right, the first stock in the list is Booking Holdings, ticker symbol BKNG. This stock currently trades around $5,000 per share, which right away makes it feel out of reach for most retail investors. But if you look beyond the price, the fundamentals are exceptional. They operate a high margin business holding about $15.5 billion in cash and generating $9.24 billion in free cash flow. That is huge. And according to my model, Booking Holdings has a 100% upside in the bull case, 55% in the base case, and even 8% in the bear case. That said, my DCF calculator suggests it's currently slightly overvalued, and I actually agree with that assessment. But think about this, if the bull case plays out and the stock hits $10,200 in 5 years, that price tag will likely keep a lot of small investors out. That's exactly why I think Booking Holdings might announce stock split sometime soon to make it more accessible. With a great balance sheet, strong fundamentals, and steady performance, Booking Holdings stands out as a high quality business worth keeping on your watch list. Next up is MercadoLibre, ticker symbol MELI. It is trading around $2,300 right now, and my valuation model shows massive potential with 342% upside in the bull case, 188% in the base case, and 80% in the bear case. I actually started a very small position recently, and I plan to accumulate more over the next 6 months, especially if it dips below $2,000, which is where I think it becomes fairly valued. And Mercado Libre also has an impressive financial profile, about $7.4 billion in free cash flow and $2.1 billion in net cash. This is a company with strong moat, dominant presence in Latin America, and robust business model. If they ever announced a stock split, it could generate increased interest among investors depending on market conditions, simply because the fundamentals justify the excitement. The third stock on my list is AutoZone, ticker symbol AZO. And this is a little different. They don't have a great balance sheet, mainly because of their debt of $11.6 billion. But here's the thing, this is one of those recession resistant steady performers with 7,600 stores globally. It's a business built for consistent cash flow, and my model shows 91% upside in the bull case, 50% upside in the base case, and 4% in the bear case. Personally, I would be interested in buying this stock if it drops to around $3,000. And this is the kind of company that doesn't move wildly, but it silently compounds. Perfect for investors who prefer stability over volatility. If a split were to happen here, it could easily attract a new wave of long term investors. And the fourth stock in the list is Costco, ticker symbol COST. Costco has one of the cleanest balance sheets out there with $20.8 billion in net cash and $7.83 billion in free cash flow. In my projections, Costco shows a 49% upside in the bull case, 29% in the base case, and about 11% in the bear case. Given its track record of steady growth, customer loyalty, and operational excellence, I think a stock split here would draw tremendous retail interest. That demand alone could give the stock a short term boost on top of an already strong long term business foundation. And finally, stock number five is ASML Holdings. ASML trades around $1,000 right now, and in my view, it's one of the finest businesses in the world. I actually traded ASML earlier this year and booked a profit. I talked about that in my stock prediction series as well. And by the way, I link the spreadsheet in the description below. It includes all the stocks I have covered along with their performance and my personal returns. So definitely check that one out. ASML's fundamentals are just rock solid, strong cash flow, wide moat, and a leader in the semiconductor space. Ideally, I'd like to buy back ASML around $800 and hold it for long term. If they ever decide to split their stock, it could reignite investor interest, something I'd personally keep an eye on rather than position for in advance. So, those are the five stocks: Booking Holdings, Mercado Libre, Costco, AutoZone, and ASML that I think are worth watching closely, especially if they ever announce stock splits. But here's where things get even more interesting. What actually happens to stock after they announce the split? Do they always go up, or can things turn the other way around? So, for that, let me share my own experiences with stock splits, because this isn't just a theory. I have actually traded through several of these. Let's start with my biggest winners, which is Broadcom. I bought Broadcom around $1,700 back in July 2024, just before its 10 for 1 stock split. After the split, I kept buying on dips, and that decision really paid off. As of today, I'm up roughly 100% on that position. Just a few days ago, I sold half of my shares to lock in profits, and I'm now riding the rest for long term, essentially playing with house money. This has truly been a huge winner for me. And the next one is Lam Research. They also executed a 10 for 1 stock split in October 2024, and that's when I started accumulating the shares. This has been another fantastic trade. I sold half yesterday to take profits, and I'm holding the rest for the long term. Lam's research fundamentals remain incredibly strong, and I see this as a great compounding going forward. And now, not every stock split turns into a success story, and that's totally okay. One that hasn't worked out for me yet is Chipotle, ticker symbol CMG. They did their stock split in June 2024, and I started buying around $65 post split. Right now, I'm down about 31% on this position, but honestly, I think Chipotle has strong long term potential. It's just going through a rough patch right now, partly because the market's attention has shifted to AI related stocks. I'm staying patient here. I believe once sentiment turns, Chipotle could easily be back above $100 again. So, those are my real life experiences, two big winners and one that's still in progress. And that's the beauty of investing. You learn, you adapt, and you keep refining your approach with every cycle. Now, I would love to hear from you. Which of these stocks would you be most interested in buying if they announced a split? Drop your thoughts in the comments below. I always enjoy reading and learning from your perspectives. And if you found this video helpful, make sure to like the video, subscribe the channel. Thanks for watching, and I'll see you in the next one.